So our second last portion is consolidation. Okay.
Mm-hmm.
I must warn you, no, it's not like the others that we have studied. This standard requires you to study certain things by heart. Okay. I'll
Okay.
be
Okay.
I'll just brush up with the logics of using certain methods in here. But in the end,
Mm-hmm.
you have to study it like you have to memorize everything. Clear?
Okay.
Okay.
Clear.
So consolidation simply means business combination. Okay. And
Mm-hmm.
this comes under the heading as business combinations. So under that, you're going to study various type of business combinations. Clear? And
Clear.
this is just a touching up topic. When you move on to the SBR, you're going to dive in very deep. Okay. So in FR and FA,
Mm-hmm.
in FA, you study a little bit of consolidation. In FR, you go a bit more in detail, and in SBR, you're going to dive
Mm-hmm.
into it. Clear?
Okay.
Okay.
Clear.
And consolidation in a business combination as a whole has many sub IFRS fixed into it. Okay. But
Mm-hmm.
ACCA does not require you to memorize those IFRS numbers. So we are going to omit the IFRS numbers altogether in this chapter. Clear? We
Okay.
just need to know
Clear.
the basics. That's it. Okay?
Okay.
Clear? So we're going to
Clear. So
start.
only the IFRS
Yeah,
standards
just
under
just
consolidation.
this just the standards,
Okay.
how it is done,
Okay.
how
Fine.
you're going to do it. That's all. Okay?
Okay.
So here, when we talk about consolidation, we are going to use alphabetics as a company name. Okay. So here,
Mm-hmm.
first of all, suppose there is a company P. Okay.
Mm-hmm.
And there is a company S. Clear? And what
Clear.
P did is P purchased more than half of the S. Clear? That is
Mm-hmm.
beyond 50 percentage. Either it can be that, or P holds maybe 40 percentage, but the rest 60 percentage is scattered among so many different investors that
Mm-hmm.
P has the whole power to take decisions in S. Suppose that is the case.
Mm-hmm.
In that
Okay.
case, P is the parent company and S is the subsidiary company. Clear?
Clear.
Okay. Now, in this case, what we do is we take SOPL of parent and subsidiary together, SOFP of parent and subsidiary together. We club it under one,
Mm-hmm.
and this is called as consolidation. Clear, no?
Okay. Clear.
Okay. Now, when you
Mm-hmm.
consolidate, what becomes P and S becomes a single entity. Understood, no?
Mm-hmm. Yes.
Okay. And suppose if 50 percentage, let's say it's 75 percentage what P is holding. Okay. Then the
Mm-hmm.
rest 25 percentage, no, it becomes the non-controlling interest. Clear? So the
Clear.
remaining percentage of whatever is there, which P doesn't own, becomes the non-controlling interest. Understood?
Mm-hmm. Yes.
Yeah. Okay, now
Yes.
the
Clear.
next combination is, suppose there is a company P.
Mm-hmm.
Okay. There is a company A. And what P did is, let's just say P purchased 30 percentage of A's share. Clear?
Mm-hmm. Clear.
In this case, the range is between 20 and 50 percentage, right?
Mm-hmm.
So P has the right to participate in decisions taken in A. Clear?
Clear.
And this is called significant influence. Understood?
Mm-hmm.
Now,
Understood.
in this case, these two cannot be consolidated. It can't be done. But
Mm-hmm.
use a different method called equity method in order to account for the associate companies FS. Clear? Or the acquisition.
Clear.
And how do you account? We account through equity method, whereby we take the cost of investment plus whatever the company makes profit, among them the share of the profit that P holds. Understood?
Understood.
And the total becomes the value of A for P. Understand?
Mm-hmm. Understood.
Now, the third case, suppose there is a company P and there is a
Mm-hmm.
company I. Okay. And
Mm-hmm.
P bought less than 20 percentage of shares. Let's just say P bought 15 percentage of I's shares. Clear?
Mm-hmm.
In
Clear.
this case, we can't consolidate. We can't follow equity method as well. So it just becomes a, an ordinary investment. Understood?
Okay.
If it
Understood.
is an ordinary investment, it is treated as IFRS 9, and then we'll decide whether it is trading or non trading, and accordingly, we choose our methods of valuating them. Understood?
Understood.
Okay. So these are the three types of business combinations that you're studying for FR. When you move on to SBR, you're going to study a way too much combinations. Clear?
Mm-hmm. Okay.
Now, in FR, the main topic is consolidation. So we're going to go back to consolidation. So when we talk
Mm-hmm.
about consolidation, there is five standard workings that you should study. Clear?
Okay. Clear.
These five standard workings is your bare minimum in order to study consolidation. Clear? So the
Mm-hmm.
first working is the group structure. Okay? First
Okay.
working is the group structure. So what we do is when we get a question, we'll open the workings and first we'll write the side ending as group structure. And
Mm-hmm.
then we are going to mention in the question, they would actually mention how much percentage has P acquired as, okay? What
Mm-hmm.
date it was acquired, okay?
Mm-hmm.
And if the acquisition percentage is given, it's evident that you can calculate the NCI out of it, right? So
Mm-hmm.
you're going to do
Okay.
just that. You're going to mention P company acquired as, okay, and the percentage of acquisition was this much, and it was acquired on this date, and maybe months of acquisition. If it is year, you're going to write year. Clear?
Mm-hmm.
Well,
Okay.
P acquired as on 1st January 2024. Then until the next accounting year, it has been 1 year since P acquired S, right?
Mm-hmm.
Like that. Okay.
Okay.
And DOA is date of acquisition. Okay.
Okay.
And DOR is date of reporting. So sometimes it could be a middle of the year, it could be beginning of the year, it could be anything. Clear?
Mm-hmm.
And NCI is
Clear.
non-controlling interest. Understood?
Mm-hmm.
The second working is net assets of subsidiary. Okay. Net
Mm-hmm.
assets of subsidiary. So how do you find net assets of subsidiary? You're going to take the share capital of the company. Clear?
Okay.
On to that, you're going to take retained earnings of the company. Clear?
Mm-hmm.
And then
Okay.
OCI, other comprehensive income. Sorry, yeah. Then OCE,
Mm-hmm.
okay.
Mm-hmm.
And then the fair value gain, okay. That
Okay.
means in the year, if the subsidiary has any assets whose fair value has raised, okay, or there is a revaluation gain, because when there is consolidation, you're going to revalue all your assets again, right? So at that time, it is possible that some assets of the company might, the value of some assets of the company might go up, right? So
Mm-hmm.
in that case, you're going to record the fair value gain. Now,
Okay.
if there is fair value gain, then you should also calculate depreciation on that fair value gain. Just a moment.
Mm-hmm. Okay.
Okay. So if there is a fair value gain, you're going to find the additional depreciation over that fair value gain. Clear?
Mm-hmm. Clear.
And this, when you do this, you're going to have two columns, that is date of acquisition and date of reporting. Clear?
Mm-hmm.
So in the balance sheet or SOFP, which is given in the question also, you will have two columns.
Okay.
Understood?
Understood.
Will have a DO, that means a current year and a previous year.
Mm-hmm.
Understood?
Okay.
So you're going
Understood.
to take it accordingly. Or else you will just have the DOR and the DOA values would be separately given. Clear?
Mm-hmm.
That is the
Okay.
easiest scenario. Okay. So you have to be careful how you take it. Share capital, if there is no issue of shares, the DOA and DOR are always same. In FR, it is always same.
Mm-hmm. Okay.
Retained earnings, the chances are you have to add profit for DOA in order to find DOR, maybe. Okay.
Okay.
And this actually could be a mistake because OCI is not something that is going to be there. Okay. So I'm just going to
Mm-hmm.
cut that off.
Okay.
Okay.
Mm-hmm. So it can either be a fair value gain or loss, or is it always a gain?
It could be loss as well,
Loss as
but
well.
in
Okay.
most of the cases, it could be gain.
Okay.
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 And then you're going to take depreciation. Okay. And
Mm-hmm.
then if the company has purchased any assets, you're going to add them, both of the columns. The resulting depreciation should also be taken. Clear?
Mm-hmm.
And the next thing is important, URP. So URP is something that we are going to discuss later. Just know it is the full form is unrealized profit. Clear?
Okay. Clear.
So this unrealized profit, we are going to take in working note 2 only if the subsidiary is the one who's selling things to the parent. Clear?
Mm-hmm. Clear.
So URP is related to intercompany transaction profits. Understood?
Okay.
Now this is the last draw. So after this, we're going to total both of the columns together. Okay. And the difference is called as post acquisition retained earnings. Understood?
Okay. Understood.
Post acquisition retained earnings. This retained earnings, that is PAR, is going to be split between the percentage of parent and NCI. So if parent
Okay.
owns 75, NCI has 25, right?
Mm-hmm. Yes.
So this would be split in between them and we'll keep it there. Clear?
Okay. Clear.
Now in the working note 3, we calculate goodwill. Okay?
Okay.
And
Okay.
goodwill is calculated in two ways. Either you are going to use proportionate share of goodwill on net assets, okay,
Mm-hmm.
which you are not going to use. And the second one is fair value method of net assets. Clear?
Clear.
Okay, so how is fair value method of net assets calculated? See, there is a simple logic. For anything that you have to sell, what do? You get the latest market value, right?
Yeah.
The same way, whichever goodwill is the extra amount of something that you get over its price. For example, it's like an artificial profit, but it is not a profit. It's called goodwill.
Mm-hmm.
Understood? If the company
Yes.
worth $100,000 assets with them, but another company is willing to pay more than that, then that means this company has some goodwill. Understood?
Yes.
Clear? So
Clear.
first we do is we are going to consider fair value of purchase consideration. So purchase consideration is what all are you willing to give them? Understood?
Okay.
It could be
Okay.
with cash. It could be a contingent payment in the future. It could be share for share issue. That means giving our shares instead of taking in exchange of taking the other one's shares. It
Mm-hmm.
could be loan notes. Understood?
Understood.
So these all are the purchase consideration that we give. Suppose we are planning to buy a subsidiary. Understood?
Mm-hmm.
Unto that, so this is the value that we give, right? So imagine
Yes.
this as an iPad. Okay, so for iPad, you have given a cash worth, let's say, thousand dirhams. Okay.
Mm-hmm.
But this is not all. In order to get delivered, you have to pay an extra, right?
Mm-hmm.
Okay. So you're paying something extra as well. So you're going to keep on adding whatever cost that you incurred to the iPad, right? In order to
Yes.
get the real cost that you have actually spent upon it. So same way, you're going to calculate fair value of what you're paying.
Mm-hmm.
Okay. Now this is not it.
Okay.
For that to become a whole company, you need to add the fair value of NCI as well. Understood?
Mm-hmm.
So you're going to add fair value of NCI at DOA. This could either be directly given, okay, or you
Mm-hmm.
have to calculate. How do you calculate? You're going to take the subsidiaries shares into the NCI percentage into subsidiaries market value of shares. Understood?
Okay, understood.
So you have added these two things together.
Mm-hmm.
Okay, now this is what the whole company is about in its fair value, right? That
Yeah.
is on the perspective of the buyer. Now, in the
Okay.
working note 2, you have calculated how much it is actually worth, right?
Mm-hmm.
That is the DOA total. Clear?
Clear.
So, after that, you get the goodwill at DOA. Understood?
Understood.
DOA means date
Okay.
of acquisition. So,
Mm-hmm.
suppose
Mm-hmm.
after acquisition something happened and the goodwill has impairment means you have to show that impairment as well. Clear?
Okay, clear.
And then you reach goodwill at DOR. Understood?
Mm-hmm. Understood.
Working note 3 is over. Next is working note 4. Okay. So working
Mm-hmm.
note 4 is we're going to calculate value of NCI at DOR so that we can take it into the FS. Clear?
Mm-hmm. Clear.
So for us to get the working NCI at DOR, you need NCI at DOA that you have already calculated in working note 3. So these are connected. If
Mm-hmm.
one goes wrong,
Okay.
everything goes wrong.
Okay.
So this you have calculated. On
Mm-hmm.
to that, you're going to take the post retained earnings that you have calculated in working note 2, NCI.
Okay.
Okay. And also
Mm-hmm.
you're going to deduct if there is any impairment, the share of impairment of NCI. If it is 25%, 25% of the impairment.
But what's the difference between the impairment we subtract here versus the impairment we subtracted
This is as a whole.
down? Yeah.
This impairment
Okay.
is as a whole. Here
Okay, fine.
you're going to take only the NCI percentage.
Okay, okay.
Understood? So after
Understood.
that, you reach the NCI at DOR.
Mm-hmm. Okay.
Now, working note 5, the most important workings. You're going to take parents' retained earnings from the SOFP. On to
Okay.
that, you're going to add the PAR that you have found in working note 2 of the parent. Clear?
Okay, clear.
Then you're going to deduct share of impairment of the parent. Okay?
Okay.
And then you're going to deduct any intercompany profits that you have gained if parent is the seller. Clear?
Okay.
It is
Okay.
important that we cancel out every intercompany transactions. Understood?
Mm-hmm.
Then you're going to deduct any finance cost that has arisen because you have entered into a contingent payment with the subsidiary company. Clear?
Mm-hmm. Okay.
So there could be interest, time value of money is there. What is contingent
Mm-hmm.
liability? It is an uncertain event in the future, right?
Yes.
So if it is future, there could be interest rate fluctuations. So there is going
Mm-hmm.
to be a finance cost over it. So you're going to deduct that finance cost from here.
Okay.
Understood? Now
Mm-hmm.
you're going to add any share of profit that you get from an associate that you have purchased. Clear?
Okay, clear.
Now you're going to deduct any impairment of that associate. That is share of impairment of that associate. Then
Okay.
sometimes in the question, there could be a professional fees. A professional fees is when an accounting or an audit firm has entered into the scenario in order to calculate all of these things that is related with the acquisition, right?
Mm-hmm.
That particular professional fees would be deducted from the group retained earnings. Understood?
Understood.
Then you reach the parents' retained earnings, which is to be taken into the combined FS. Clear now?
Mm-hmm. Clear.
Now, working note 6 is that of associate. So, what you do is in the question, there could be some information available for how much you have spent on an associate. You're going to take that. That is the cost of investment. On to
Mm-hmm.
it, the share of profit would also be given. You're going to take that. And you're going to deduct share of impairment, which would also be there in the question. And after that, you reach associate value. And this method is called equity method. Understood?
Understood.
Okay, now rules of consolidation. Consolidation, what is a consolidation? You are bringing in the SOFP together and you're bringing in the SOPL together. This is called consolidation. Clear now?
Clear.
So, what are the rules? First rule is that all the assets and liabilities you're going to combine. Understood?
Mm-hmm.
That means
Yes.
you're going to add them together. Second rule is any of the transactions which was happening between the groups would be cancelled out. Clear?
Mm-hmm. Clear.
That is called intra-group transactions. Third one is consolidation is going to be done as if P is acquiring whole of S. Okay? And
Okay.
whatever P doesn't acquire, it should be shown in NCI, non-controllable interest, on a separate note, on a separate section actually. Clear?
Mm-hmm. Clear.
Fourth one is at the date of acquisition, the consolidation would start. That means you are to take proportionately if need be. Understood?
Mm-hmm.
Now, at that time, all the assets and the liabilities of the subsidiary are going to be taken in fair value, and the goodwill is then calculated as above that we have just told, right?
Mm-hmm. Yes.
That we have just followed. The fifth one is that you're going to prepare consolidation. That means the consolidated FS in the year end. Understood?
Understood.
So this is the rule regarding consolidation.
Okay. So I just need to like memorize the steps.
Yes, important, most
Okay.
important. Okay.
Okay.
That is why I told I need 2 to 3 classes for consolidation for sure.
Mm-hmm. Okay.
Okay. So I'm gonna stop here. What I want you